Hey, this is Bert Salazar. I'm hoping that you and your family are doing well. Last week, I held 22 individual video conferences with my online community. So 26 were scheduled. I was able to host 22 of them. So that was an 85% scheduling to attending a video conference. So that was really, really good. And the majority of my online community and the people that I was talking to last week were very concerned about the taxation on their retirement accounts, and also, how to create guaranteed paychecks, because they have been watching and listening to some of my podcasts and videos regarding retirement distribution and the fact that you have to do it for so many years. By the way, I may be speaking with a little bit of a lisp, so it's not that I'm creating a new accent for myself. It's just that I had oral surgery a week and a half ago, so I have a little plate on top of my mouth, so it's giving me a lisp as I talk to you. But I hope you can appreciate that, and hopefully we'll get through this as quickly as possible. So in doing this, obviously there were a lot of questions, there was a lot of back and forth, and it was really, really good from a business perspective. So I appreciated that quite a bit. But by the same token, I got the idea that I wanted to put together not only a podcast, which I did yesterday, but also I wanted to put together a video for you regarding some of the issues that I saw from last week meetings with all of these individuals from the online community. And I decided to name it, how to rope-a-dope your retirement to success. How to rope-a-dope your retirement to success. Now, if you've been around a while, you know the story about the rope-a-dope. Obviously the greatest of all time, Muhammad Ali, who was the greatest boxer that I ever saw, kind of created the rope-a-dope as he was getting older in his fighting years. Why? Because people were his opponents were getting stronger, they were getting quicker, they were getting tougher. So he still needed to find a way to be able to fight at that high level and be successful along those lines. So he created the rope-a-dope, in which pretty much he lured his opponents to the rope, and then he would just stand there and take punches left and right, take punches and so forth. And with the idea that eventually, after a few rounds, the opponents would kind of punch themselves out, and then Muhammad Ali would just come out and knock them out and win the fight. And he did that time and time again. He would get into a fight, and all of a sudden jabs were being thrown, and he would just go against the rope and just say, "Come on," and he would just stand there. Obviously he took a lot of punches, but he also won a lot of fights. And I thought that was very interesting. I said, well, how do I get that information, and how do I take that that process that Muhammad Ali used, and how do I assign it, and how do I equate it to retirement planning and retirement distribution and your retirement accounts and so forth? So I decided to make this video for you, which is how to rope-a-dope your retirement to success. So I wrote a bunch of notes that I'm going to go through with it. And you may ask, well, Bert, what does a rope-a-dope have to do with my retirement planning? And I would argue it has to do everything with it, because most retirement accounts are sitting around dormant. Most of you that are putting money away in your IRAs, your 403Bs, your 401Ks, or whatever retirement account you're basically doing, yes, you're making the contributions and so forth, but many a times you're not visiting with your financial advisors if you have one. You're definitely not visiting with them on a quarterly basis, which is something that you should be doing. So I decided to put, something together for you to kind of help you think, outside of the box from a business perspective. So you don't have all of those retirement accounts in a rope-a-dope scenario. So that's important for you to be able to see. Now, always remember that when it comes to business, you can either be the windshield or you can be the bug, and it's entirely up to you. And what I have seen in all the audits that I have done, at least over the last 15 years on retirement accounts, is that the majority of the time, the clients that I'm auditing for the first time, they were actually the bug and not the windshield. So they're never going to win that fight. So I'm going to walk you through some of the ideas that I jotted down for you to kind of hopefully open your eyes up to maximize your retirement accounts and manage your retirement accounts in a way that you're not going to be the rope-a-dope of Muhammad Ali. You're not going to be that opponent that was punching away at Muhammad Ali, and that opponent had a false sense of security because he thought that Muhammad Ali was old, was not in shape, was not prepared for the fight, and it was totally the opposite. So, many of you are managing your retirement accounts the same way that those opponents were punching away at Muhammad Ali without understanding what was behind that theory or that way of fighting that Muhammad Ali adopted later in his life. Now, one of the biggest fights in his life was with the great George Foreman. And by the time Muhammad Ali fought George Foreman, I think it was in 1974, Muhammad Ali must have been like 92 years of age. I'm only kidding, but he was pretty old. And obviously, nobody had been able to beat George Foreman at that time. He had fought everybody, and nobody had lasted more than 2 to 3 rounds. So, all the bets were against, at least in Vegas, were totally against Muhammad Ali. And they fought in 74, and Muhammad Ali did the rope-a-dope. And obviously, in the 8th round, he came back out and knocked George Foreman out. So that tells you the power of the rope-a-dope. And now I'm going to apply it to your retirement accounts and your financial matters. Now, most of the retirement accounts that I see once I do an audit, like I said, they're dormant. Contributions are being made sometimes, other times they're not, but they're being dormant and they're actually being rope-a-doped by the IRS, the government, and financial institutions, because those 3 governmental and institutional areas would like you to continue to, be a rope-a-dope when it comes to your retirement accounts, because if you really get smart in your retirement accounts, then chances are you're going to pay a lot less taxes to the IRS than you would otherwise. So that would be a good point for you to consider. Obviously, what I have also noticed is that, these accounts are being allowed to increase and decrease without any type of rhyme or reason. And many times your retirement accounts shouldn't be losing value. Your retirement accounts should always be making money or at least breaking even. So if you're losing money in a retirement account, obviously you're being rope-a-doped, by the government and the IRS and financial institutions, because remember, financial institutions are going to be collecting their fees, whether you make money on your account or you lose money on your account, one way or the other. So if they're going to get a 1% fee or 1.5% or a 2% fee, which is the one that I'm seeing the most, they're going to get that 2% fee right off the bat, whether you make money on those accounts or not. So that's important to know. Now, most of the surveys that I have read in the last 2 to 3 years, show that Americans are really interested in tax-free retirement planning. The challenge is that 96% of Americans have not done anything about that. Only about 4% of Americans understand how to create tax-free retirement plans and are able to maximize the efficiency of those retirement distribution plans by making them tax-free. But you need time and you need an analytical approach in order to be able to do that. And that's important. Most retirement accounts grow tax deferred, but that also means that the tax liabilities are continuing to grow. And what do I mean by that? Well, if you're putting money away in a tax deferred account or in the tax deferred bucket, which would be your qualifier plans, your IRAs, your 401ks, your 403bs, and so forth, the money that you put in is pre-tax. The money grows tax deferred, but then when you pull the money out, you got to pay taxes on that money. So what I normally hear from some of the clients that I engage for the first time, and some of you as part of my online community, is that, Bert, if I put $10,000 into a 401k, I'm saving money on taxes because I don't have to pay any taxes on that contribution to that 401k for that year. Well, that couldn't be further from the truth. And the reason is that you're not saving any taxes. All you're doing is you're postponing the tax. And when you postpone the tax, you also postpone the tax liability. So the question that I have for each and every one of you watching this video today is, where do you think that taxes are going to be in the future? Are they going to be lower? Are they going to be at the same level, or are they going to be at a higher level than they are today? If you think they're going to be at a higher level than they are today, then you're more than likely absolutely correct. Because somebody has to pay for the mess that we're living in today. We're almost at $25 trillion in our national debt. Our deficit is north of $1 trillion as of 2019, and now 2020 is going to go even higher. And the unfunded liabilities for Social Security, Medicare, Medicaid, and Medicare Part D are exceeding $140 trillion. So the only way that the government is going to be able to pay for all of these things is by raising taxes. And if you don't know this, on January 1st, 2026, your taxes are going to be higher than what they are today. And the reason for that is that the current tax law, the Tax Cuts and Jobs Act, will actually sunset December 31st of 2025. So when we all wake up January 1 of 2026, taxes are going to be higher. But depending on who's going to be in power at that point in time, I would argue that taxes are going to be a lot higher than that, and taxes are going to have to almost double, or our country is going to go bankrupt. So the IRS wants you to continue to fund your retirement accounts because that's a savings account for them. As a matter of fact, many times I would ask my clients, look, which financial plan are you planning for? Are you planning for your personal retirement or that of the IRS? Because the way that most of my clients were actually funding their retirement accounts prior to visiting with me, they were pretty much funding the IRS and the government's retirement plan as opposed to their own. Another point is that if you don't do proper tax planning with your retirement accounts, you will actually be paying anywhere between 5 to 8 times more in taxes to the IRS than what you should have. And the reason for that is lack of tax planning inside of your retirement accounts, and then having the ability to make certain that you do it the right way. Now, some of the things that I'm noticing, and I'll share some of those with you now, is that retirement accounts are not being coordinated with either Social Security benefits or Medicare. And what do I mean by that? Well, what I mean by that is you got to figure out if your Social Security benefits are going to be taxed in retirement or not. And one of the main reasons why most Social Security benefits are being taxed in retirement is because Americans have way too much money in that tax deferred bucket or in those retirement accounts, because at some point in time when they start taking those Social Security benefits and they thought that those Social Security benefits were going to be totally tax-free, all of a sudden they get bombarded with a tax liability that they were not expecting. And the reason for that is that when you start taking Social Security benefits, your accountant, and obviously the software that the accountant is using, but this is something that I do for my clients every year because I do tax forward planning. So I want to make certain that my clients prepare their retirement accounts in such a way that they only have the optimum amount available into those retirement accounts, because if you have anything above that and your retirement accounts were to overflow, you're going to have all kinds of tax issues at a point in time in your life that you cannot really afford to have since or then. So what are some of the things that you need to consider? Well, first of all, when you start taking those Social Security benefits, you have to do provisional income calculations. Now, don't tell me, I know 99% of the financial advisors that you're working with have never talked to you about provisional income calculations, and many of them have no clue what provisional income calculation is, because of the fact that they're not tax planners and they're not retirement strategists. Most of the financial advisors that I see out there, they're primarily asset gatherers. Or if you have an IRA or a 401k, they would want you to transfer those assets to them so they can bring it under their roof. And obviously they're going to collect a fee or a commission. Some of them are going to do an okay job. Most of them are not, because they're not retirement strategists. So What is provisional income calculation? What is a calculation that you have to use every year, you have to do every year in order to determine what percentage of your Social Security benefits are going to be taxed in retirement. And what you do is, in the year that you're taking your Social Security benefits, the calculation will force you to take 50% of that Social Security benefit. To that calculation, you have to add your ordinary income. So if you continue to work after you started taking Social Security benefits, whether you did it on a full-time or on a part-time basis, whether you did it as self-employed or as an employee, you have to take those W-2s and the 1099s and add them to that calculation to determine what percentage of your Social Security benefits are going to be taxed. In addition to that, if you're taking money out of your retirement accounts, and this is the biggest culprit of them all, if you're taking money out of your retirement accounts, all of those monies that are coming out need to be added on to this calculation, again, to determine how much in taxes you're going to have to pay for your Social Security benefits. Then once you've done that, you have to also add dividends and capital gains. So any dividends and capital gains that you have received for the year, you have to add it into the provisional calculation bucket for determining, the percentage of Social Security taxes you'll have to pay. And then last, but definitely not least, you'll have to add the interest from municipal bonds. Now, although municipal bonds, you will receive federal income tax-free if you do it the right way, the income that those municipal bond funds generate, they get added on to the provisional income calculation. So you got to be very careful in not taking too much municipal bond on any given year, because it could be a detriment to your Social Security benefits. And then once you have all those calculations in place and you run the formula, that will tell you whether you will pay no taxes on your Social Security benefits, and that would be a really, really good job on your part. Whether you would pay whether 50% of your Social Security benefits will be taxed in retirement. That's not going to be so good. Or even worse, if up to 85% of your Social Security benefits will be taxed in retirement. So you have to be very careful when you start taking money out of your retirement accounts. Not only do you have to pay taxes on those accounts, but those accounts can also impact not only the taxation of your Social Security benefits, but also whether you're going to have to pay additional premium on your Medicare premium on a monthly basis, because Medicare premiums are determined by the overall income that you're reporting under the IRS code for tax purposes on any given year. So it's important that you understand, and this is why, the IRS doesn't want you to do anything. They want you to maximize your contributions to these retirement accounts. So they're actually rope-a-doping you into building a false sense of security for yourself, your family, your business, your retirement accounts, and your retirement life, thinking that everything is going to be fine. Because one of the major problems is, if your Social Security benefits are taxed, then there's also a probability you're going to run out of money before you run out of life, anywhere between 5 and 7 years, or sometimes even 8 years sooner than expected. And the reason for that is that if you now have to pay taxes on your Social Security benefits, that's going to create a hole in that bucket, in your financial bucket, that you're going to have to fill. And the only way you're going to plug that hole is by taking additional income from your retirement accounts, paying more taxes on that income, so that you can have a net that would plug that hole that your retirement Social Security benefits taxation created for you and your family on that given year. So you have to be able to be very careful as to how you manage those retirement accounts. It's not just asset allocation, it's also tax allocation that you need to worry about from that perspective. Another thing that I notice is that retirement accounts are not being coordinated with your pensions. and or self-created pensions. So one of the things that I do for all my clients, when we put together an annuity portfolio inside a pension or a retirement, inside retirement accounts, in order to create guaranteed paychecks for them and their families for life, I manage, how we do that in order to make certain that we segment the right amount of money going into those pension benefits, so we can offset any potential liabilities that we may have in the future. And I have to do that every single year for each and every one of my clients that is getting closer and closer to pulling the trigger on retirement as far as years remaining may be. Retirement accounts are not being coordinated either with 7702 plans or municipal bonds. 7702 plans are a great tool for retirement because it is cash value life insurance, which the money grows tax deferred and you can pull it out tax free. And many of my clients overfund their 7702 plans in coordination with municipal bonds and the tax-free bucket that I'll talk to you in the next few minutes regarding those areas. But it's important that you're able to coordinate your retirement accounts with all of these other accounts and different taxation summaries and features and benefits, because otherwise they're not going to be able to work concurrently with one another in order to provide a more efficient and a more effective retirement distribution plan for you and for your family as well. Another thing that I'm noticing is that many times real estate investments and retirement accounts are not being coordinated with real estate investments, and that's sad. I do have a number of clients that have investment properties. They have rental properties. Now, because you have a rental property, you have the ability to take a lot of deductions, but then the income that is coming in from rental properties is ordinary income. Now, you also have that capital gains growth. If at some point in time you're going to sell a property for gain, I have other clients that like to do a lot of flipping. They buy older properties, they fix them up, they repair them, and then they sell them. Sometimes they get a long-term capital gain, but most of the time is short-term capital gains that will be taxed just like ordinary income taxes. So you have to be able to coordinate your real estate assets with your retirement accounts as well, in order to make certain that you're doing the right job for yourself and your family, and that you're reducing those tax liabilities as much as you possibly can. Because again, the IRS, if you don't do anything, they're pretty much ropey-doping you, and they're actually by the fence, or by the ropes, and you're punching yourself out and you don't even know it. And by the time that you retire, it will be too late, because now you're going into your Social Security benefits, you're pulling these benefits, and you're also having to pay taxes on all those benefits and on everything else, and that's jeopardizing. Now, some of you may say, well, Bert, am I not going to be in a lower tax bracket when I retire? Number one, you hope you're not, because otherwise that means you really haven't done either a very good job in your retirement accounts, or you haven't done any proper tax plan. In a perfect world, you want to continue to earn as much income as you were earning prior to retirement, but having that income come to you totally tax-free. But unless you do proper tax planning, you're never going to be able to accomplish that. And if you're not able to accomplish that, even if you're making less income than before you retire, most of the deductions, exemptions, and credits that you were able to use while you were employed or in business, you can no longer use when you're in retirement. So your tax liabilities may even go higher just because you don't have those tax shelters available to you after you decide to retire. So that's something very, very important that you need to also take into consideration. Now, always remember that most of the clients that I meet for the first time, and most of the online community people that I talk to, like the 22 that I spoke to last week, most of their assets are either in the taxable and the tax deferred account. Very few of those assets happen to be in the tax-free account. And because of that, you need to have the ability to maximize those, the tax-free bucket, which is comprised of your Roth IRAs, your Roth 401ks, your 7702 plans, and your municipal bond funds. And if you do it collectively and you do it efficiently, obviously now you're going to have a much better balance between the taxable, the tax deferred, and your tax-free bucket when it comes to retirement. The other thing that I noticed is that retirement accounts are not being coordinated with your standard deduction. And if you're smart and you know how to do it and you prepare in advance to be able to do it, you may actually have the ability to pull money out of your retirement accounts and not have to pay taxes on those retirement account distributions because you were able to use an account offset in order to not have to pay taxes on those retirement accounts. Now, you still have to report them for tax purposes under the IRS code, but any taxes that you would have paid on those retirement accounts would be offsetted because of the standard deduction offset, which is something that I coordinate with my clients, and that's why I manage how much my clients are contributing to their retirement accounts, because I want to make certain that there are no surprises at some point in time in the future. And that's something that if you're interested, I can show you how to do, and I can even do it for you if you so desire. Most Americans have not created any type of Roth IRA transitioning program, Roth conversion, transitioning distributions, and not even the ability to create a backdoor Roth. So if you do it the right way, you need to have an IRA transitioning to Roth program in place, and you would do that sequentially every year. You would also should have in place a Roth conversion strategy that you should be working with your financial advisors. I know they're not working with you on this, and this is something that they should be doing with you every single year. And then last but not least, for those of you that may make a lot of money and you really can't contribute to a Roth, well, how about doing a backdoor Roth IRA? And there's a strategy and a technique that you can use in order to do that. If you start to use these accounts this way, and you're able to promote them by doing provisional income calculations, by doing IRAs and Roth IRAs, conversions, and obviously the backdoor Roth, then all of a sudden you're starting to move assets from your tax-deferred accounts, which is forever taxed, to your tax-free bucket, which is never taxed for the rest of your life. And the sooner you start doing that, the better it's going to be for you, because all that growth is going to be tax-free for the rest of your life. Always remember that with traditional retirement accounts, depending on your age, you need to start taking required minimum distributions either at age 70 and a half or age 72 under the new law. But any assets that you have in 7702 plans, municipal bonds, Roth IRAs, and Roth 401ks, once you convert them, there's no mandatory and no required minimum distribution. So you now have control of the distribution rate of those accounts as opposed to the IRS. All of a sudden, instead of you being rope-a-doped, you're the one rope-a-doping the government, the IRS, and financial institutions for the betterment of yourself and your family along those lines. Now, what else can I tell you? I always say that fools always part with their money. So you have to make certain that you understand how it is that you manage your retirement accounts from a business perspective. And we're getting to the end of this short video. 99% of Americans will not know how much income they're going to be generating in retirement from one year to the next. So most Americans have retirement accounts, they just don't have a retirement plan. Because if you don't know exactly how much revenues and how much income and how big your paycheck is going to be from one year to the next, then you really don't have a retirement plan. All you have is a bunch of retirement accounts that you're hoping that will do well for you in the future, but hope is definitely not a financial strategy and definitely not one that I would recommend to all of you. So having a guaranteed paycheck for life, knowing exactly when you wake up every day, how much money you're going to be receiving from a retirement standpoint on a monthly basis, where that money is going to be coming from, and most important, whether that money or a portion of that money is going to be either totally tax-free or partially tax-free, is a win-win for you and your family. And if you're not doing it now, then you're being rope-a-doped once again. And it's your fault, by the way. If you're being rope-a-doped, it is your fault. Don't blame anyone else. Now, you may want to blame your advisors because they're not telling you the things that I'm sharing with you today. But if that's the case, then you need a new advisor. Perhaps you may even either find somebody else or reach out to someone like me that can help you put a rope-a-dope type of plan that is going to work on your favor, so that way you can win every single retirement fight that you may be facing at some point in time in the future. Now, last but not least, you also need to control the distribution timing of your retirements. And by creating that tax-free bucket, you're going to be able to do that a lot more efficiently than you would otherwise. But one final thought before I leave you is the only way that you're being rope-a-doped is because you're playing checkers with your retirement accounts while the IRS is playing chess. So you have to make that paradigm shift, and you have to shift all of that all around. You got to start playing chess with your retirement assets and your retirement plan and your retirement life, because the IRS has been playing chess since day one. So there's no way that you can play checkers and beat the IRS when they're playing chess with you. Always remember that if you want to reach out to me, please feel free to do so. You can either talk to me about this or anything that is keeping you awake at night from a financial standpoint. You can reach me at area code 786-766-1042. You can also send me an email at Bert, B-E-R-T, at bertsalazar.com, bertsalazar.com. And always remember, my goal for you and your family is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So once again, stay very, very safe, stay healthy, and I'll talk to you very soon. Take care. Have a great day.